OpenAI has not been having a great year. As it completes its metamorphosis from a non-profit organization operating for the good of humanity to a shareholder-focused company gearing up for one of the biggest IPOs in history, it has come up against some, teething problems. It is facing legal challenges over the fair use of intellectual property, legal challenges over its governance, legal challenges over the safe use of its tools, talent churn amongst its top developers, and now significant reputational damage amongst effectively all of its stakeholders. All of this wasn't helped by its willingness to embrace what many see as war profiteering, further straying away from their original stated goal in order to chase revenue wherever it can find it. Because, well, fully autonomous AI killbots and mass surveillance systems don't really sound like they are improving the future of humanity. In response to this, over just the last weeks, some of even the most staunch AI optimists have spoken out against the decisions this company has been making. But anyway, all of this is on top of the biggest and most immediate problem of all, which is that OpenAI is simply burning billions of dollars every month on top of trillions of dollars in future spending commitments with no clear answer for how it's going to get that money. Now, maybe this would all be okay if it was still the undisputed leader in this world-changing technology. But in the last 3 years, several other models from better-funded companies have come along and either matched or exceeded OpenAI's capabilities. It's now unclear if the early pioneers of this technology have spent hundreds of billions of dollars developing systems that can now be effectively replicated by random Swedish men in their bedroom. It's also becoming less clear exactly how world-changing this technology really is going to be in the first place, putting more question marks over the company's future. For now, its investors are doubling down. Just last week, Amazon, who is theoretically a competitor, Nvidia, a supplier, and the ever-reliable SoftBank announced a record investment of $110 billion in additional funding, which will keep the GPUs on for another few months. But this lifeline has, in turn, presented another potential issue that would almost sound absurd if it wasn't for a growing pool of people raising the alarm bells over it. OpenAI, alongside some other big names, have now become so valuable in private markets that if they do all go public this year, their collective weighting could legitimately break the stock market.
OpenAI, as you rightly pointed out, had talked about almost $1.4 trillion in investments.
Google, Amazon, Microsoft, Nvidia, they're all kind of backing everyone right now to lift up the wider AI market.
OpenAI declaring code red as the AI race intensifies, and Google threatens to unseat the industry's early leader.
These U.S. big tech corporations are fear-mongering about China.
That raises a lot of questions about how OpenAI employees feel about this.
Workers using AI are more productive. They're also more burned out than ever before.
Brad, if you want to sell your shares, I'll find you a buyer.
Now, despite how it may appear from the outside, the business leaders and investment managers pouring hundreds of billions of dollars into OpenAI are fully aware of the questions and criticisms people have about the business. It's not like every single person on the internet has seen something that the CEO of Microsoft or Nvidia somehow didn't get the memo for. They are all capable of doing the basic arithmetic that concludes that a lot of these numbers don't really make a lot of sense, but they are still betting on it anyway. By the business fundamentals alone, yeah, it doesn't look great. But to these mega investors, the case for OpenAI can continue to be justified so long as 4 things remain true. Now, unfortunately for them, out of those 4 variables, there are only 3 that the company can really control. It has to maintain extremely strong user growth, preferably amongst users that are actually willing to pay money for the service. It has to demonstrate that those customers will actually stick around to be profited off of, and it has to remain a viable contender for the long-shot bet of developing genuinely world-changing superintelligence. If the company can show investors that a large group of people are willing to pay a recurring subscription fee for their services, it is a good indication that there may be a path to profitability in the future, even if they are losing a lot of money at the moment for every customer they serve, even those in the top subscription tiers. If they can fully capture that market, they can basically try to do what every tech company ever has done, through a gradual process of enshittification. The game plan is simple. They start out with a really useful and cost-effective service, get people used to using it, drive out all competition, and once they have done that, they can raise prices, cut costs, and integrate other revenue streams like ads to profit off the user base they have cornered. For technology in particular, this is a very effective strategy to build companies, because the marginal cost of every additional user is effectively zero, so the benefit of being the sole player in the market is enormous. A company like OpenAI also has an advantage here, because over time, the cost to deliver the same service should come down naturally as technology improves. It may not feel like it at the moment, especially if you have tried to build a computer recently. but the cost of the hardware and overhead needed to run AI is coming down extremely quickly. Tokens are the basic building blocks of AI-generated content, so it's easiest to track them as a point of comparison. According to data from the AI Index report prepared by Epic AI, when ChatGPT first launched in late 2022, the cost to produce 1 million tokens was around $11. In early 2025, that cost had come all the way down to just 9 cents, with some models from competitors running even cheaper. Now, that is the most recent data that has been reliably reported on. But the trend is that since very early generative models, the cost per token has been having 2.7 times over every single year. The only reason why spending has increased so much overall is because OpenAI and its competitors are spending a lot on training larger, more capable models, and we are just using a lot more of these tokens overall. The data is hard to collect, but according to the tracking platform OpenRouter, the number of tokens consumed rose by over 38 times over a 12-month period ending late last year. This is all to say that even if AI remains nothing more than a little handy tool, the demand for those tools is rising, and the cost to deliver them is falling just as quickly. Additionally, the CEOs are betting that once a powerful enough model is developed, they won't need to keep investing the enormous amounts of money they have been in the early development stage. That means if one of these businesses can corner the market, they could make a lot of money with something as simple as a subscription model, or yes, even advertising. If an OpenAI subscription becomes as ubiquitous as a Netflix subscription, then that alone could justify the value of these investments, because Netflix by comparison does not have the luxury of movies becoming 27 times cheaper to produce every year. This is not even considering the revenue that could come from commercial or government clients. But well, yeah, we will get to that soon. This is also ignoring the long-shot bet that OpenAI is, or at least was, the frontrunner for developing some kind of superintelligence with capabilities worth tens of trillions of dollars. A lot of real experts on this topic have pointed out that this kind of scenario is extremely unlikely to happen. But even if there is only a 1 in 1,000 chance, if that investment could pay out 10,000 times over, it's still a good bet, especially if the backup plan is merely becoming one of the most valuable SaaS companies in existence. It's a great story that almost makes it sound like these big tech CEOs may not be intentionally lighting their money on fire after all. But before you personally get your checkbook out, it's time to learn how money works to find out why this story may be starting to fall apart. It's not just the companies that you hand your data to willingly that you need to worry about. Hundreds of data brokers are collecting and selling your personal information right now, and most people have no idea it's happening. That's why this video is sponsored by Incogni. Your email addresses, phone numbers, home address, and more are probably sitting on data broker websites ready for scammers and identity thieves to buy. And it's not your fault. It's mostly because the companies you trusted with your data weren't careful enough with it. Incogni automatically contacts these data brokers on your behalf and demands they remove your information. They handle the back and forth, the follow-ups, and the legal requests so you don't have to. They can even handle custom removals for specific instances of your info being leaked online. Just Google yourself and you might be surprised to find that news sites, fitness apps, or random websites you've never heard of are holding and sharing your personal details. Incogni will go after those individually too. The way I see it, they can't steal your identity if they have no idea who you are. Go to incogni.com/howmoneyworks or use code HowMoneyWorks at the link below to get 60% off an annual plan and take your personal data back. Okay, so behind the scenes, some of the optimistic outcomes for these variables has not been panning out too well for OpenAI, and of course a lot of those challenges were brought to the surface last week. If you are not up to speed, the brief summary is that Anthropic, the company behind Claude and OpenAI's chief rival, pushed back against the Department of War over using their technology for fully autonomous armed drones and mass surveillance. Now, we are already a long way beyond Asimov's 3 laws of robotics here. But many people were still willing to give credit to Anthropic for doing what you might reasonably consider to be the bare minimum, especially when they were put under significant pressure from the government. Now, all of that public good was very quickly turned into animosity when just a few hours later, OpenAI turned around and signed a similar deal with the Pentagon, effectively announcing that they were willing to forgo these extremely basic AI safety guardrails if it meant that they could secure a lucrative government contract. Now, I respect your time and I know most of you are probably already up to speed on this, but if you do want more details, I will leave a link to some articles in the description, as well as some great detailed commentary done by Mr. Glizzy Hands himself. Now, the whole situation is very interesting and frankly terrifying from the ethics side of the AI debate, but it has also been quite revealing from the business side as well. Following this episode, a lot of people are actively boycotting OpenAI's products and considering alternatives, with the biggest winner so far being Anthropic itself. This undermines the narrative of continual user growth, and it highlights that people are not really that attached to any particular brand of AI. For the past 2 years, OpenAI in particular has been able to command an investment premium in part because it was the first thing that people thought of when it came to large language models. It was the Google, Coca-Cola, Band-Aid, Clorox, and Velcro of AI tools. To a lot of average people, ChatGPT was just the way to use AI. It was also assumed that once people got used to using a particular model, it would be very hard to get them to switch, which in turn would make it easier to generate profit through higher fees and a cheaper service. This whole Killer Robots episode may not single-handedly destroy OpenAI, but it has been a very visible demonstration that people are happy to switch if they see a reason to. Competitors have capitalized on this by releasing tools to make this switch between models as seamless as possible, even for users who had a lot of custom-trained data built up with OpenAI. This has hit 2 of the 3 stories that OpenAI needed to keep going in order to maintain investor interest. And it also hit this last one as well. The race to secure talent in the AI space has become somewhat ludicrous, with pay packets into the tens of millions of dollars a year. But companies are hoping that these salaries will be worth it if it improves their chances of making a general intelligence. The blowback over these ethical decisions will make it harder for OpenAI to attract these high-end researchers, and it will also make it more likely that the ones they currently have will look for opportunities with competitors. Now, of course, some of these people may not really care about what their AI is doing as long as the paychecks come in. But with multi-million-dollar signing bonuses being thrown around, at the very least, these ethical concerns are a great excuse to jump ship. Big investors care about these talent movements, because the more these people move around, the more the institutional knowledge gets spread around. If a highly skilled developer spends 2 years at OpenAI and then moves to Anthropic, they are going to bring with them some level of know-how about how to develop similar capabilities. Now, obviously, these people will be under very strict non-disclosure contracts. But even without copying anything directly, these programs are ultimately the product of the people who designed them, and a whole lot of stolen intellectual property. But we don't talk about that part out loud. These knowledge leaks make it more likely that AI will just become a commodity that any somewhat competent business can create, rather than a centralized product that people need to pay for the privilege of using. Now, this isn't exactly unprecedented in the world of technology either. For all of the emphasis that is put on being a pioneer in a new field, it rarely, if ever, guarantees business success. Nobody uses Alta Vista, BlackBerry, MySpace, or Skype anymore, despite them all at one time being the cutting edge of their respective fields. Now, for a company like Google, Meta, Microsoft, Amazon, or even xAI, this isn't as big a deal. If AI does become a universally accessible commodity, then all of the money they have spent building their own capabilities may have been a waste. But at least the cost-cutting made possible by this technology could still help their core business functions. This is, in part, why companies like Google and Amazon are developing their own AI products, while simultaneously investing in their own competition. However, for a company like OpenAI, if they can't monetize the technology itself, they are in big trouble, especially since they have made some of the most significant upfront investments to develop this whole industry in the first place. An analogy that has been thrown around is that they are like a cheetah that has used a lot of resources to hunt down this new technology. And now that they have, the bigger, slower predators can come along and steal the rewards without having to use as much energy of their own. Now, of course, the other major tech companies have invested a lot of money into pursuing this technology, but it was largely money that they already had, and they have other profit centers to keep this going even if investors get cold feet. Which brings up that one big variable they can't control. The big investors can keep justifying the money they spend on OpenAI so long as their investors see the potential for the technology, or at the very least, see the opportunity for the hype to generate some kind of a return on their investment as they sell their stake off to the next person in line. Investor enthusiasm around AI is already waning, and market conditions alongside higher interest rates aren't helping either. But the ultimate light at the end of the tunnel for a lot of these early investors, as well as the employees paid in company stock, is to take the company public so that they can cash out their positions to the general public. Now, so far, the company has only teased the idea of an IPO with no formal plans actively submitted, but it is still worth considering how such a move might play out, because whether you like it or not, it's probably going to affect you. In any scenario, an initial public offering brings a lot of additional scrutiny onto a company as its financials and operations are thoroughly picked apart in the due diligence process. This has been the undoing of several hyped companies in the past, most famously WeWork, a business built on bold promises that didn't quite live up to the optimism of the eccentric founder, also backed by major investments from SoftBank. Now, honestly, this is probably a bit unfair. OpenAI is at the very least a real technology company, not an office subletter that pretends to be a technology company. But it will still present a hurdle for a slightly different reason. Going public means that the company leadership will be subject to a lot more regulation about the stories they are allowed to tell. Altman in particular has gained a bit of a reputation for making big promises about the financial potentials of his businesses, including those that he ran before OpenAI. This kind of messaging will need to be picked a lot more carefully in the run-up to a listing and after the company is public. Now, I know what you might be thinking. A lot of public company CEOs have made a mockery of these regulations, and enforcement by bodies like the SEC has effectively amounted to a slap on the wrist with a wet noodle. But for such an important business, it's not impossible that enforcement action could be used against them punitively if they don't play along. I mean, it literally happened just last week. So yeah, OpenAI has made promises that financially cannot afford to keep for technology that is no longer special being offered to users that are moving to competitors and talent that is being spread around to higher bidders that come with less reputational baggage. As these problems have caught up with the company, it has tried things that are looking increasingly desperate in order to keep the numbers moving in the right direction. Goonbots, integrated advertising, and questionable military contracts may have introduced additional revenue streams, but they made all of these fundamental challenges even worse. It sounds bad, but I guess we should talk about how this company might, break the stock market. So despite all of these problems, OpenAI could still easily be the largest IPO in history. After the most recent $110 billion investment, the company claimed a pre-money valuation of $730 billion, which already makes it one of the most valuable companies in the world, slotting right in between JP Morgan, Chase, and Exxon. Now, not all shares would be made instantly available on the market on the first day, but even assuming an extremely conservative 5% of the company's shares, it would still be close to $40 billion in float, topping even Saudi Aramco's IPO, which was a state oil company and not really a fair comparison. As a closer comparison, when Facebook went public in 2012, it put up 15% of its stock to raise an inflation-adjusted $22 billion. A similar offering from OpenAI would be 5 times that. Now, the market is obviously a lot bigger today than it was 14 years ago, but the majority of net share purchases are now done by companies themselves buying their own stock. An IPO this big would represent a significant share of the actual new investment into the market, theoretically meaning that there would be less investor dollars for everything else. Now, that might be a problem for the market, not OpenAI, but at the same time, there are other big IPOs rumored from SpaceX and potentially even Anthropic. Collectively, these companies could raise more money this year than the last decade of IPO activity combined. That cash has to come from somewhere, and the fear is that the market just won't be able to bear this much supply in such a short period of time. According to the Z1 accounts of financial activity, the $450 billion that just these companies could look to raise would be more than the net buying activity seen in US markets in a lot of years. And that's ignoring every single other company that people might want to invest in. If OpenAI can't raise this cash, it will put more question marks over its future and proposed spending commitments. The sheer size of these potential new public companies is also raising another concern, which is that large indexes that track the stock market will have to readjust to include them. Index funds from companies like Vanguard, BlackRock, and State Street automatically adjust their holdings to weight their indexes proportionally to the value of the companies within that index. The most valuable companies in the world today all started out as relatively small cap stocks that just kept on growing, giving these indexes time to weigh them more heavily as they gradually grew. If these 3 IPOs all go ahead at their proposed values, they would instantly jump close to the top of these indexes, which could force these large asset managers to sell down a lot of other companies in order to correctly weight their indexes to reflect the market. Now, not to get too nerdy, but if only 10% of these companies are actively sold on the market, then most indexes are float adjusted, meaning that only 10% of the company would be counted towards overall holdings. But even this could present a major shakeup in a short period of time. My good friend Ben Felix actually spoke directly to Vanguard's global head of investment implementation in a podcast he did last year. So if you want to get really nerdy, they go into a lot of the technical details about how this could play out. Now, nobody really knows exactly how these challenges will play out, including the company themselves. But unfortunately, the trend is towards a majority of this risk being dumped onto public investors, or just the public in general. If these companies fail, they could bring down the market with them. But if they succeed, it will likely be because they were used to displace a large share of the workforce.